In this video, I'll be going over what to do when the count is a little bit confusing from an Ellie wave perspective. And to leverage this concept that I'm about to teach you, we actually are going to step away from the real price chart and look at an idealized line diagram. So as we all know, this is what our very typical idealized Elliott wave progression looks like. We can, of course, label these waves 1, 2, 3, 4, 5, and then A, B, C on the right. So what does this mean? Well, it means that we have an uptrend. The left-hand side, right? 1, 2, 3, 4, 5 kind of confirms to us that we have an uptrend. And on the right-hand side, the ABC tells us that we're in a pullback. And what we can expect now is another 5-wave advance to the upside. But let's remove the Elliott wave labels for a moment. Just by looking at this, if I showed this idealized line diagram to like a 5-year-old and I asked them, what direction would you say overall we're heading? They would say, well, we've gone higher than we've gone lower. Undeniably. Undeniably, that is the answer I would get from pretty much everybody. And that's factual. Even accounting for the depth of this pullback, assuming that everyone knows this is a diagram of a market, the market is still higher, given where we ended here, than where it started. But we need to have a little bit more of a defined framework in terms of how we're assessing whether something's in an uptrend or something's in a downtrend. So here is the framework that I like to use. It just very simply relies on pivot points. So here, for instance, we have a low. Here we have a pivot point where the market pulled back and then started to move higher. Call this a swing low. But it's higher. It's a higher low than the first low down there. And this low is higher still. And on the flip side, we can look at the high points, the swing highs. So here is a high. Here is a higher swing high. And here's yet another higher swing high. And then what happens? The market breaks down. We make a higher low. Okay, if I draw a horizontal line, you'll notice that this low is still higher, so it's a higher low. But what happens next? The market can't make a new higher high. The market exhausts itself here and turns down, at which point we have a lower low. So at this junction, right here, I would say that the market is in a downtrend until further notice, all right? When we're dealing with technical analysis, we're doing 3 things simultaneously. We are looking at past price action as being the best predictor of future price action. So that's actually 2 things combined in one. We're looking at the past to predict the future. So we're looking at the past and we're looking at the future. But we also have to deal with what the market is doing right now in real time. So we're trying to accomplish 3 things at once, looking at past, present, and future all at once. That's what makes market analysis so difficult at times. Okay, so based on what I know about the past, I know that so long as we do not pull back beyond the start of this movement here, then we can feasibly expect another 5-wave movement to the upside. But at this stage right now, is it not possible that we get something like this and we break to new lows? Of course that's possible. I've seen it. You've seen it. Everyone's seen it. So as of right now, what can I tell you? I can tell you that the uptrend is broken based on this very simple mechanical framework. The series of higher highs and higher lows on the left has been broken. Yes, I can count 5 waves. Yes, that should tell me the direction of the larger underlying trend is to the upside. That's an assumption we're making. That is an assumption we're making about past price action and what it tells us about what to expect in the future. But it is nonetheless an assumption. So what we're looking at now, all right, is a series of lows, lower highs, and a lower low. All right, so here's our first wave down. Could be an A, could be a wave 1. We don't know. This is wave B, could be wave 2. This is wave 3, or it could be wave C. Why is this important? Because, well, if the market breaks higher here to make a new high, then the uptrend has resumed. Why? Because we now have a new high. And we can say here, here's my origin of the uptrend. This is a low. This is a higher low here. This is a higher low. And on the swing highs, here's my first high. Here's my higher high. Here's a higher high. And here's a new higher high. The uptrend is intact, right? That's forecasting the future. But looking at the present, what happens if we get this? Well, what I can tell you is we have a lower high now. And then here, I can say we have a lower high now. Sorry, here we have a lower high. Here we have a higher low. What if we get this? Well, now I would say here we have a lower high. And what happens if we get this? I would say we have a higher low. What is that indicative of? Well, it just means that we have a series of lower highs and a series of higher lows. Well, that equals sideways price action. What pattern fits sideways price action the best? It would be a triangle. So now take a look at how I label these waves. A, B, and then we can expect a decline in C. And then we have a wave B triangle. And now we can look for a decline. And remember, an LE wave triangle has 5 points. A, B, C, D, and E. I'm just going to blow these labels up. There we go. A, B, C, D, and E. All right. So utilizing this very simple concept of looking at market structure, I can start overlaying LE wave analysis very simply, very quickly to figure out what is what and what is going on. Okay, now let's say that that's not what happens. We don't get this sideways triangle. In fact, we're going to look at getting something else. Okay. What happens if we get something like this? Yes, I'm aware we have 5 wave movements on the left, right? Now, so long as we remain in a 3-wave movement and we break to a new high, we can say the uptrend is intact. But look what happens here. Now we have a series of lower highs. And here we have a series of lower lows. Now, if I rewind the tape, this is where we were. We were saying this looks like a completed ABC sequence. It's exactly what we would expect from a simple zigzag, but then we get a lower high. So now, as I'm seeing this in real time, what I'm thinking to myself is, well, is this going to be a lower high or is it the first wave of the resumption of the uptrend? Well, I have to wait and see. If I don't get a corrective pullback here and we break to a new low, then now I have a series of lower highs and lower lows, and that keeps my focus firmly on the downside until I see a break in this pattern of swing points. I see a lot of Elliotticians fall into the trap making assumptions about the market, assumptions with unfounded evidence. Of course, we have to make assumptions to a degree, but those assumptions should be informed by good evidence. We shouldn't be making leaps. We shouldn't have to do mental gymnastics to try and figure out what the heck is going on a chart. So what I mean by that is, at this stage, I would say a safe assumption with no further information is that we're looking at a 5-wave advance followed by a 3-wave pullback. If I get this, followed by this, well, now that's new information. This is new information. I have to rethink things. I have to say, well, this looks quite bearish to me. It doesn't actually look bullish because we got a 3-wave movement down, yes, but we got a very small 3-wave movement up, followed by a break of this swing point, and then as we get more information, let's say we break to a new low. Well, that's not indicative of bullish price action. Why? Because Elliott wave count aside, we have a lower high, we have a new lower high, and we have a series of lower lows that we now have to contend with. In real time, I have to focus on the downside now. Now, yes, I can zoom out and say, so long as we stay above this point, I'm bullish. Right? It's perfectly acceptable to do that. It just depends on your time frame as a trader. And this is where we have to move away now from these idealized line diagrams and go to real markets so that we can understand this concept of what it means to look at things from various time frames. So if all I see is this large bearish decline in XLF, which is the Spider Select financial ETF, then I can say, so long as we don't take out this high, I'm bearish. Remember, folks, here's my high, here's my low. I can say that here we have a lower high, here we have a lower high, here we have a lower high. And then the moment we break above that, I can say, well, shoot, now we have a new high, we're not in a downtrend anymore. Now, it's perfectly acceptable. Let's say the only thing I want to do is play XLF on the downside. I'm only interested in shorting XLF. I don't want to go long the ETF. I'm not saying that's smart. I'm not saying that's wise. I'm just saying, let's say that is the kind of trader you are, right? Well, in that case, you're going to be waiting and not taking any action because there's no evidence of a lower low. There's no evidence of the market putting in a lower high and then a lower low at any juncture here. Why? Because here we have a swing high, here we have a higher low, here we have a higher high. At this point, even though from an Elliott wave perspective, I can think maybe this is a three-wave movement, all right? I have to respect the structure of the market, which is making a series of higher highs and higher lows. Here's a higher low. Here's a higher high. Here's a higher low. Here's a higher high. And then we get the most difficult Elliott wave pattern to contend with of all time. Perhaps this is an expanded flat. So you'll notice that going from a higher high, the market immediately makes a lower low, right? And then what happens? And then the market makes a lower high. The market makes a higher low. And then we break out to a new higher high as soon as we break above this point here. So the uptrend does come back into focus very quickly. Right? So market structure is very important because it doesn't, what market structure does is it tells you what's happening right now. You can't forecast market structure. Market structure is telling you what's happening right now. We use Elliott wave analysis to forecast the future, right? The problem with forecasting the future is that very often you fall into the trap of seeing something that you want to see. You want to see something, and therefore you see it, all right? With market structure, there's none of that. You cannot deny market structure. You cannot deny a series of swing highs and swing lows. It is extremely evident on the chart. So if we wanted to count this, you know, there's a number of ways we could count it. I could say, well, 1, 2, maybe 3, 4, and 5, and then we have an expanded flat here, A, B, and C, maybe as a wave 2, maybe as a wave B, and maybe 1, 2, 3, 4, and 5, and maybe that's wave C. And all together, that would mean that I have an A, B, and I'm looking for a massive collapse in our financial system, the American financial system, that's going to see wave C take us to new lows in XLF. I mean, isn't that possible? Can't this be, you know, wave A, wave B, wave C for wave A of a flat? Remember, flats are 3-3-5 structures. So that's a ABC for wave A. And then we have A, B, C for wave B. And then we're going to get 1, 2, 3, 4, and 5 for wave C. Is that not possible? Of course it's possible. The more bullish count, right, would be that this is wave 1, this is wave 2, this is wave 1 of wave 3, 2 of wave 3. We're going to go up in wave 3 of wave 3. The point I'm trying to make here is that I can reasonably, looking at virtually any price chart, come up with both a bullish count and a bearish count. Which count I prefer is going to depend on which count follows the rules and guidelines the most closely, right? That is almost always going to be the preferred count. But here, the stakes are very large. It's not helpful for me to say, well, it could go up or it could go down. I need to put parameters in place. So the parameters that I would use is market structure, because market structure is the only thing that can tell me in the here and now what's going on. So as long as we have a series of higher lows and a series of higher highs, don't I have to respect this uptrend? You know, all I can say for now, I'm not saying we're going to get a higher high followed by another higher low, followed by another higher high. I'm just saying as of right now, we're in an uptrend. I would have to see us break this swing point down here. I'd have to see a break below 29.59 in order for the trend to potentially have changed. Right? Now I can keep in mind, maybe this is just wave C and then we're going to go to a higher high. Yes, of course I'll keep that in mind. But if I get a break below here and we get a corrective pullback, then I can be safe in knowing that the market structure is on my side. And now I have a high here, I have a low, I have a lower high, I have a lower low, I have a lower high, and I'm looking for a new lower low. Right? That's the power of market structure. That's how market structure keeps you on the right side of the trend far more often than not. All right, well, I could show countless examples of how market structure overlays with Elliott wave analysis, but I hope you get the point here. I intended for this video to be fairly short, and I think it's run far over time. So in any case, hope you enjoyed the video, hope you learned something new. Talk to you soon.